Hello friends, in today's episode, I'm going to cover how you value a vacation rental business accurately. How do you value a vacation rental business accurately? So by the end of this video, you'll have all the tools and tips to be able to value your vacation rental business accurately. Imagine having a clear understanding of your business's worth that will enable you to make strategic decisions with confidence. Have you ever wondered what makes one vacation rental business more valuable than another? Have you ever looked at what key factors professional appraisers use when valuing a business? I'll reveal the critical elements and methods to ensure that your valuation is spot on. And I'll do that by first giving you a current overview of the vacation rental business as it sits right now in the economy. Next, I'll dive into the different ways to evaluate your vacation rental properties. And finally, I'll cover what key factors play a role in affecting the evaluation of your vacation rental business. If you're ready, let's go. Let me give you a quick overview of the vacation rental industry as it sits right now. So in 2023, the global vacation rental market sat at about $95.4 billion. And by 2028, that market size is expected to go up to $133 billion. The rising expenditures on travel, vacations, and accommodations among millennials are driving that growth. Now we got to understand that the global vacation market isn't all rosy and things are great. Here are some things that you need to look out for. You've got to look out for saturation. Some areas have exploded with vacation rentals, and some of those areas are just filled with them that make it very saturated, and it allows the guest to be able to pick and choose, which means some vacation rental properties, if they don't stand out or they aren't unique, are not being rented nearly as much as they were maybe 2, 3, 4 years ago. And that's kind of a situation that we're in our property in Blue Ridge, Georgia. Now, we're fortunate that we're in a great location. We have amazing views of the sunset over the Blue Ridge Mountains, and so our vacation rental does really well. But we have seen from maybe 2022 to 2023 a little bit of a drop in the revenue from one year to the next. However, we are still seeing demand and growth in that area, but it's that situation where you either adapt or die. You've got to do things to enhance your property to make it stand out, because if there are a ton of properties out there, you need to make yours stand out and be unique. Because of that, and because of the economy, we see inflation going up, rental prices are dropping in a lot of areas. A lot of experienced owners think price is the issue, so what they do is they lower the price in order to get their vacation rentals filled up. And one of the final things is, with interest rates so high, many of the current owners who have bought in the last few years aren't breaking even on some of their vacation rental properties. And this becomes problematic because 2 or 3 years ago, if you're able to get an interest rate at 2.5%, 3%, 4%, and your mortgage payment is maybe $2,500, that same property, that same valuation of the home, and that same mortgage payment with just a higher interest rate is going to be probably twice of what you were paying 2 or 3 years ago if you got the loan then. And this is making it difficult for many owners to break even or to make the numbers pencil. Now, it's not all doom and gloom. The desire to vacation has never been greater. But what the current market suggests to me is you have to do your due diligence when you're looking to buy a vacation rental property. Now let's talk about how you value your vacation rental business accurately. The first thing you want to do is look at each home inside your portfolio and get a valuation for that property, right? Let's say you have 5 properties in your vacation rental business. Each one should have a valuation, and that valuation should give you an idea of how much money you want to get out of that business. So here's a quick snapshot. So let's say that you have a vacation rental property, and let's say that you're thinking of selling it for $600,000. Now, this is a simple, very easy way that I look at it to see if it makes sense if I were an investor. Number one, if gross rents are at least 10% of the purchase price, that's okay, right? So $600,000 you want to sell it for. If you're bringing in at least $60,000 in gross rents, that's an okay deal. But let's say that your property is bringing in $90,000 a year. That's 15% of the gross rents of the purchase price. That is a good deal. That's a really good deal, actually. However, I've seen properties that maybe you're looking to sell for $600,000, and that's what you want out of it, that they could pull in $120,000 a year in gross rents. That would be 20% of the purchase price. That is an absolutely standout deal that people don't want to pass up. Now, on some of these Facebook groups that I'm a part of, I'm part of one called Short-Term Rentals for Sale, and I've seen people list their properties, and many times, if they're getting a lot of traction on those properties that they're selling, typically gross rents are at least 13% or above the purchase price, and that's where they get most of the action when it comes to listing their property. Now, that's just a quick snapshot. It's not something that'll give you the valuation of your property, but it gives you a good starting point. Now let's do a deeper dive into understanding net operating income and cap cap rate. Because when an investor goes out there and they're looking at a property, obviously they want to make sure that the income that's produced from that property, it takes the gross revenue, you minus out all the expenses, minus the mortgage payment, and that gives you net operating income. And then from that point, net operating income divided by the purchase price or the price you're listing it for is going to give you a cap rate. And a cap rate is what investors use on the fly to determine if this property or this investment is even worth their time compared to other investments out there. But let's understand and let's figure out what cap rate is on a piece of property. So I've already written the numbers up here. I've taken an example of our home in Florida to say what would be a valuation or what would I value that property at if I was going to sell it individually or value it inside our portfolio. And this is exactly what I did. I took gross rents for the entire year. Gross rents on that property in Florida are $147,551 for the year of 2023. That was gross rents. That was all the money that came in from all of the guests that we had, including cancellations. Then what I did is I added up all the expenses. And this is everything from taxes to insurance to platform booking fees, property management fees, cleaning fees. And then here's a few other things that I do. I will take the gross revenue and I'm going to put expenses in there for the year on certain items like maintenance. Properties that are rented out on a short-term basis typically have a little bit more maintenance. Things need to be fixed or replaced. So I take 4% of the gross revenue and that is my maintenance budget for the entire year. I'll also take capital expenditures. Now, capital expenditures are money that you reinvest in the property to enhance it and make it look good. And I take 2.5% of the gross revenue, and that's my budget for the year. I then look at all the utilities, electric, gas, water, garbage, cable, internet, HOA fees, and then I have total utilities and management fees. So I add up all those expenses, and for our property in 2023 in Florida, here were our total expenses for the year. $49,830. Now to get net operating income, I'm going to subtract those expenses from the gross revenue, and that gives me $97,721. Just at first glance there, if I want to say, okay, I want an investor to have a pretty good return on this business, if I listed it for $950,000, would that be a good return on investment? So what you do is you take the potential sale price or purchase price and you divide that into the net operating income. So if I divide $950,000 into the net operating income of $97,721, it is going to give me 10.3% cap rate. Now, if an investor were to say, listen, I'm looking to buy something that's going to give me at least a 10% return on my money, this fits that perfectly, right? I know people who buy storage units at 5 or 6% cap rate. So a 10% cap rate, and if everything's in place and running smoothly, that's a great investment. Because if they paid $950,000 for that property, they know every single year they're going to receive $97,721 every single year. So if you were to tell somebody, listen, you give me $950,000 for this property every year, you're going to receive $97,000 in change. In a matter of 10 years, that property would be paid for. So now that we have that down, let's talk about what factors will affect your evaluation. Well, obviously the first thing is numbers that we just went through. Most investors are buying a property to make sure that the numbers fit, that they can service the debt, and that they can make a little bit of profit or a lot of profit throughout the term of owning this property. And that is going to be first and foremost the most important thing. Another factor that will affect valuation is the uniqueness of the property. A diamond is valuable because it's really rare. So if you have a property that's unique and different, that's going to stand out. That's probably going to be worth more than just a cookie cutter home in a neighborhood, right? I just saw recently on the Facebook group I'm a part of, short-term rentals for sale, this person was selling a handful of properties he had close to the Smoky Mountains, and he had some absolutely amazing properties. This guy understood exactly what it meant to stand out and have something unique. He had a property that had a mini golf course out in his front yard, and it had a train track with a small train that went around his entire property. I mean, holy cow. He had over 120 comments on people that were interested in that property. And also, as you can imagine, gross revenue was great because people wanted to rent that property. And as with most real estate investments, location plays a vital role. If you're in an area or a location that property values have been good and they've appreciated most years, year in and year out, especially over time, that's going to be a huge factor in the valuation of your property. Now, these are some things that I've done or that I've seen that help increase valuation or help me understand valuation of my properties and then into my vacation rental business. I'd be interested in what you've seen and what you've done. So please comment below. Let's engage in a dialogue. And as always, I've got a free gift for you. It's aaronsfreetraining.com. Just click on the link below. It's a vacation rental calculator. You put in the revenue and then you put in the expenses and it's going to spit out to you whether it's a good deal or not. It's going to give you the net operating income. It'll give you the cap rate. It'll give you all the information you need to help evaluate your business. And as always, thanks for stopping by. Have an amazing day.